Well, we look more at specific locations and asset classes, but I think there is a mismatch, again, between investor appetite and where the opportunities are. Again, talking to investors, even investors who are thinking that they want to put opportunistic type capital to work with relatively high risk appetite, a lot of them are the non-European investors are very worried about genuinely pan-European funds which can go anywhere and do anything. And they tend to want there to be a focus on the UK, Germany, and France. And logically speaking, one would think that a lot of the opportunities are going to be in UK, Germany, and France because of the size of the markets, the economies, and also the banking sectors. But of course, when you look at Southern Europe and particularly Spain and some of the sort of peripheral areas, there could be some very interesting opportunities there. But our focus is on the UK, Germany, and France. I think. We think, and probably less so France, we would like there to be more opportunity in France, but the culture's really not there in terms of restructuring. It's not a particularly creditor-friendly environment, as David alluded to earlier. And we just don't find people attuned as much to the opportunistic kind of investing process in the French market. But of course, we have a very big presence in France, so we're always looking for the opportunities there. As a real estate asset management firm with a capability to manage assets across Europe, we would love there to be more pan-European opportunity. But it's difficult at the moment, so we are kind of focused on those three markets.
We have seen some sort of unusual deals in Spain actually with sort of non-Spanish banks providing stapled finance on selling shopping centres and subordinating the stapled finance to return on the equity, alternatively transferring the shopping centre into a vehicle for €1 subject to a much larger debt, and they've been taking the view that they still have the same ultimate recovery, so therefore don't have to recognise a loss. And I think that the Bank of Spain has, I think, just prohibited that by saying that if you retain a 25% exposure, then you can keep the whole thing on your balance sheet.
And in terms of your clients, Mathieu, what are you seeing? Are you seeing that there are opportunities arriving that are maybe, I don't know, in Greece or in Spain or in Portugal or Italy or CE or any of those areas? How are you seeing that in terms of the geographic spread, if you like, of opportunities?
I think I would echo what Ross was saying. I think it takes really pretty brave institutions to go and venture in Greece or in Portugal just now.
Anybody brave in the room?
That's not to say it's a bad idea, but just looking at where the volume is, I think the UK is by far and away, from general European inquiries we're dealing with, the most popular jurisdiction, but not far away, followed by Germany. I think increasingly, people are looking at the fundamentals, macroeconomic and demographic situation of these countries, which is quite interesting actually in the conversation we've been having with investors 6 months ago. Before you had a number of conversations where people were like, well, actually, I can get that yield in France and that one in Germany. Now it's, well, hold on a minute, actually, in Portugal, it's X% unemployment, blah, blah, blah. Ergo, even if I buy in and it looks relatively cheap, what am I going to be doing with this in 3 or 5 years' time? I'm not quite sure where this country is going, let alone property prices. So I can't comment on really, is any of these specific markets an opportunity? But if people bring them back to the fundamentals, I'm sure that will come at a price. And a number of these markets as well, I think even historically, and I've spent a bit of time in Portugal looking at some loan books over there. Historically, these are very small markets, very closed markets, where effectively your exit is likely to be local. In that situation, I think an outside view says that it's a pretty risky bet to make. I think Ireland is a bit different because people can see the light at the end of the tunnel. I don't think anybody knows how long the tunnel is, but people can see the light. Where on some of the others, we don't know whether it's a tunnel or a wall.
I've seen the views, but you almost need to know how long the tunnel is, because for sort of prime Irish, on the assumption there's been an overreaction in the capital value of prime, you only need sentiment to change, and there'd be an uplift in value, and therefore you can potentially get out earlier before the economy has turned itself around. And you see where sort of Irish bonds are trading. There is, as you said, a very sort of increasingly positive view of that.